There are several functions of money used as a medium of exchange, unit of account, and store of value. Medium of exchange means it can be used to buy and sell goods. We didn't have money originally. Originally, whenever there was a trade, there is only barter. What is barter? B-A-R-T-E-R. It simply means, for example, I'm a bakery. I have some bread, and I would like to get some fish. And I have to go to the fisherman over there and ask him, can I get some fish in exchange for, I can give you bread in exchange for some fish. So there's no medium of exchange, just goods for goods, service for service, produce for produce kind of thing. The problem of this is, first of all, the demand has to be mutual. If I want some fish, the only thing I can offer is bread. And I go to the fisherman and say, do you want some bread? If the fisherman wants some bread, that's ideal. He'll just give me fish and I give him bread. But if he does not want my bread, instead he wants some cotton, then I had to go to the farmers of cotton and ask if he likes some bread, and I got some cotton, and go back to fisherman to give him cotton and get some fish. So it's just very inconvenient. So later people start to look for or find some medium of exchange. The heavy metal like silver and gold have been used as a medium exchange for a long time in a lot of countries, and they are still very valuable. And that's a good thing about it is scarce, is valuable, and the value the price is volatile, but the value kind of consistent. So, but the problem is those things are very heavy and there's a wear and tear, and hard to divide. I have a pound of gold, and I want to get some bread. I have to just peel a small sliver of that. It's just, there's other way of exchange. You have a coin and silver, but my point is it's just heavy to carry, and there's wears here, and they're hard to divide. So people look for something new, easy to carry, and as a medium exchange, now we got the paper money. There's some coin, and a monetary bill. And the second function of money is unit of account. Goods are valued in dollars, so we can compare their value horizontally. Previously, if there were no money, you're having bread, you want to have some fish, you had to figure out how many loaves of bread you need to give to the fisherman, how many in exchange for one fish. It's kind of hard to do a horizontal comparison of different goods. You say, you have a hard time to measure if there is no standardized unit of account. You cannot say, oh, okay, this sheep is worth 10 fish, and this, and one fish worth 10 loaves of bread kind of thing. And it's just challenging. Whenever you have money, it's really easy. I just say it's worth how much amount of money. And it's used for store of value. People now use the electronic pay, use their bank a lot, but as money is liquid, what's the meaning of liquid? money can always be used to exchange for alternative stuff. As opposed to what? As opposed to the money in a saving account or in bonds or stock market, you have to first liquid those wealth and then convert them into money in order to buy something else. Money is the most liquid wealth way of storing value. So you say your grandma just put some cash underneath the mattress, as opposed to deposit in a bank. There's a way to store value. You got $100 there, it's still gonna be $100 10 years later. But if you put $100 in stock market, this time it's gonna disappear because of the recession, kind of thing. So it's less of a risk, although it cannot bring you interest, it cannot bring you extra wealth. It is not one type of investment. All right, so here I want to say some more technical term. Whenever we say money, we have this blur idea. Money, of course, those monetary bill, those green paper, sure, they're money. Is that all? What about my credit card? What about my debit card? What about my Apple Pay? What about the money in my bank account? What about the money deposit in the one card of ECU? Okay, so here in the finance world or in economics world, whenever the bankers or the finance people or economists talking about money, we have a different definition for money. Depends on what, based upon how liquid they are. The most liquid type of money, we call them M1, the first tier of money, M1. It includes currency. Currency equals coins and paper money. And currency here is referred to as token money, which means the face value of the currency is unrelated to its intrinsic value. $1 bill and $100 bill, they have the same size. They have the same intrinsic value, which means the same size of piece of paper with the same technology, same everything. There's no other intrinsic thing or value in it. But the difference is they have different face value. Apparently, most of the time, generally speaking, the face value of the currency exceeds the actual value of the piece of paper it is printed on, or the value of the metal in the coin. In rare situation, whenever there's a hyperinflation, the monetary value, the face value might be equal or even smaller than the intrinsic value. In that time, people don't want money anymore. They would rather have the same size of toilet paper to do some alternative use. But whenever there's deep, crazy inflation, there's corresponding amount of a problem. But generally speaking, face value of currency exceeds the actual value of the piece of paper. And there's a checkable deposits. In your bank, most of you guys, I believe, you have a bank account and you have a check account which can be linked with your checkbook. And there's other accounts, for example, savings account and a high money market account. Those are not included in M1, instead included in M2, which we're going to cover next slide. Why? Because those items are not as liquid as the checkable deposits. including traveler's check. And for those institutions offering checkable deposits, there are 4. There's a commercial banks like Wells Fargo and everything. And there's a savings and a loan association. So I want to give you a little knowledge point. So in the bankers or the insiders of in the financial institutions give the savings and loans associations abbreviation as S and Ls. That's very intuitive, right? S and Ls. Okay, S and Ls. You see this on some some paper or newspaper or some documents. It means, if you see this, it means a savings and loan association. And there's a mutual savings bank, and there's credit unions. So the 4 of those are all institutions that offer checkable deposits. And I'd like to give you another quick knowledge point. There are 4 of those. We call those savings and loan associations, S&Ls, mutual savings bank, and credit unions. We give those 3 of those, just these 3. 3 of those a special name. They're called thrifts. Thrifts. Okay, so you can just say institutions offering checkable deposits include commercial banks and thrifts. THRIFTS. But here I want to emphasize that, the money or all of those held by public individuals and institutions like business and firms, they're M1, they're money. But the currencies or those checkable deposits held by Federal Reserve, commercial banks, thrifts, any of those held by any of those and their banks, which is Federal Reserve, are not included as money or M1. Only those held by the public, like each one of you and the businesses and other non-financial institutions, not one of those, are included as M1 or money. The ones held by the institutions or banks, Federal Reserve, are not included in M1. Why? We will talk more about that in next chapter. Okay, the second tier of money, M2, it include M1, what we covered just now, and the near monies. What's the meaning of near monies? They can be converted or liquidized into M1, but with a small amount of inconvenience. So for example, the savings deposits including money market deposit accounts, small denominated time deposits, money market mutual funds, all of those, generally speaking, if you put in a saving account or small denominated time deposits, the bank require you to have your deposits there for a certain amount of time. If you withdraw early, it's going to either hurt your interest rate, interest rate promise you, or they're gonna fine you a small amount of money. They want more. They would like to have the chance of loaning this amount of money out for a certain amount of time. So they want you to guarantee that you are going to have this deposit in the account for a certain amount of time. If you're saying you cannot do that, you want to withdraw early, you increase their inconvenience and hurt their interest profit, so that they will kind of fine you or do not keep the interest rate they originally promised you. And here, what is the meaning of a small denominated time deposits? For the third bullet points, that refers to deposits less than $100,000. Less than $100,000 is beyond $100,000 is to go to a different tier. So small amount. So if we can tell the relationship between M1 and M2 in this chart. So for M1, we can say the currency, the monetary dollar bills and coins only accounts for a smaller half of this M1, 43%, while the checkable deposits accounts for 57%. The two of them compose the money supply first tier M1. We can say is only $3,000 billion. And the M1 only accounts for about a quarter of the M2. Okay, it's 25%. The big amount of M2 is composed by saving deposits, including money market deposit accounts, 66%, and there's some 6% of those M2 is money market mutual funds, and the leftover is small denominated time deposits. That's how they split this pie. Now we say, okay, we take it for granted that we can use this piece of paper to get the things we need to buy the stuff we want. But how did we build up this belief system? Because the money supply is guaranteed by the government's ability to keep the value stable. So it said that money is debt. Later I'll talk about why. Pretty much that means that the banks own you such an amount of monetary value of stuff. I'll talk more about that in chapter 15, 16. But the government just back it up. Previously, at one time, the money supply of a nation was linked to the nation's gold supply. Pretty much means how much of gold this nation has, they can only issue corresponding amount of money. That's called gold standard, which was pretty good and solid system to prevent the government to do whatever they want to. For example, printing a lot of money, inflation kind of thing. But there's issues. Of course, we'll talk more about that. For a big country, for example, if United States unfortunately happen to have a small amount of reservoir of gold, then how can this country divide this small amount of gold among a big population? On the other hand, if there's a small country in Europe, just fortunately got a huge gold reservoir, and it just automatically make it richer. So it's kind of mandatory and arbitrage. So most of the nations moved away from the gold standard because managing the supply of money is more sensible than linking it to gold or some other commodity those whose supply might change arbitrarily. So nowadays, people are willing to accept money in exchange for goods and service because they believe that they will be able to exchange the money for other goods and supply. And the currency in the United States is designed as a legal tender by the United States government, which means it's deemed as a valid and legal means of paying any debt that was contracted in dollars. You go to any institutions, go to anywhere, generally speaking, if you pay with the money with dollar bills, they cannot reject your pay. They can tell you their preferred way of doing something, but they are not supposed to turn down your payments because you're simply offering monetary bills. And another thing is money derives part of its value from its scarcity. There's certain amount of money issued by the Federal Reserve and printed by the Mint, Bureau of Mint. So it's very scarce, so it just keeps its value. But whenever the government print a lot more money than the GDP, like what the government is doing now, the society is likely to suffer from an inflation. And the supply of money is controlled by monetary authorities to ensure it retains its value or purchasing power. Now I have a quick question for you. A quick question. Is credit card money? Alright, I don't know your answer. I believe some of you said yes, some of you said no, and some of you just cannot get a straight answer. First of all, credit cards are not money. It's not M1 and not M2 is not money. It's just a delayed way of payment. It just allows the businesses and the individuals to economize the use of the money. But the debit cards come from the checking accounts, are considered money. Okay, remember the previous slide said M1 include currency and checkable deposits, so debit card can be used as money. Okay. So because of this, money is backed up by the government. It's also the government responsibility to stabilize money's purchasing power. They have to be very smart and very strategic about managing the money supply, and that's called monetary policy, which we're going to cover in chapter 15 and 16. And it has to be used with a proper fiscal policy. Monetary policy and fiscal policy have to be used hand in hand to be successfully, to make sure the government is successfully positively influencing the overall economic performance. Okay. Monetary policy is used in short term, while fiscal policy is used in long term, as we covered in last chapter. After talking about the money, let's talk about the system controlling the supply of money. First one is the Federal Reserve. Federal Reserve is the bank's bank, is the biggest guy of the banking system. Okay. So just give you a quick look at everything. this is a system of Federal Reserve and the rest of banking system. So on top, there are board of governors. What are the board of governors? So for the board of governors, generally speaking, they are the central authority. There are 7 board members appointed by the president for 14 years of terms that are staggered so that 1 member is replaced every 2 years. And this long term provides the board with a continuity, experienced membership, and independence from political pressures. The presidential race is every 4 years, but this board can run 14 years they wouldn't just no politicians should bend their ear, and they will not lose their job because the president or somebody is unpleased with them. And here's more details of the Board of Governors of Federal Reserve System, and those are current committees. And there's a more detailed description on the Wikipedia if you're interested in looking at who they are and their corresponding term. And for the board of the governors and combined with the Federal Open Market Committee. What is a Federal Open Market Committee? I'll talk more about that later, but it's pretty much including all the 7 members of Board of Governors. On top of that, the president of the New York Federal Reserve Bank and 4 of the remaining presidents of Federal Reserve Banks on a 1-year rotating terms. All of those people compose the Federal Open Market Committee. They're helping the boards of governors to set up monetary policy, and they also conduct open market operation, which is a very, very important tool for monetary policy, for changing monetary policy. Again, we're going to cover this later in chapter 16. Okay. So you can just think about those guys are the brain, the big brains of this banking system. And they are designating their policies onto 12 Federal Reserve banks. If you can look at over here, there are 12 of those, and we can say most of them are concentrated on the eastern side, because whenever the system was established in early 1900, the Wild West is not as populated, big population, therefore high demand for the banking system are mainly at the East Coast. So we have many more Federal Reserve banks in the Eastern Coast than the West. And they just give each Federal Reserve a number. Boston is 1, New York is 2, and Philadelphia is 3, and Cleveland 4, Richmond 5, Atlanta 6. So if you're interested in this, get a monetary bill: $1, $2, $5, $10, $100, $20. Get it out, and on the face, there's supposed to be some letter over there, maybe L, A, B, C, D, E, F, G, H, I, J, K, L, M, N kind of thing. And there's a number following it. For example, A1, B2, C3, for D4, and I believe a lot of your monetary bills from F6 Atlanta. It means the dollar bills is issued by the corresponding Federal Reserve Bank. Okay, and a lot of our monetary bill is from Atlanta. Okay. And the bank system, the Federal Reserve Bank system, is called a bank's bank, because they're dealing business not with us, but with the commercial banks and the thrifts, including S&Ls, mutual saving banks, and credit unions. So if the banks are short in money, they borrow from the Federal Reserve. Federal Reserve charge them an interest rate, or they borrow from each other, or the banks, the Federal Reserve only do their business with the commercial banks and the thrifts. And those financial institutions issuing checkable deposits, they do business with the public, like households and business, every one of us. That's the system. And I already talked about the Federal Open Market Committee. They are very important. They supplement Board of Governors and to set up the monetary policy. And another very important job of them is conduct open market operations to design or to implement new monetary policy. And generally speaking, for the commercial banks and thrifts, commercial banks, there are 6,000 in the United States, and there are 8,500 thrifts. And those banks are merging all the time, and DOJ just keep approving those mergers, which to me is not a good thing, or to any consumers. So there are 12 largest financial institutions. The biggest one, the first one is in mainland China. The second one is in Special Administration of China in Hong Kong. The third one, JP Morgan, is ranked the third one. Then there's European, and there's another Chinese one, and there's more European, United States ones. Okay, so those are the big guys for the financial institutions. Now we know the whole system. Let's talk a bit more about the Federal Reserve's function. First of all, their job is to issue money. Let's say they set up the supply. All right, so they set up this is the price of money, which is interest, and this is money, and they set up the supply for money. And but they do not print money. The printing task is performed by the U.S. Mint. And the federal facilitates the movement of money by providing the banking system with a means of collecting on checks. And here I want to say something about the interest rate. We say, Federal Reserve being decreasing the interest rate and everything. Actually, the Federal Reserve does not really set the interest rate. It sets a unique interest rate different from our everyday life. It sets the discount rate, a special interest rate that is, it charges to banks for short-term loans, which then contribute to the rate of the banks charging consumer and loans. So if you're looking over here, I said the Federal Reserve will not do business with the public. They do business with commercial banks and thrifts. If the commercial banks thrifts want to borrow some money, they can borrow from each other, and most important, they borrow from Federal Reserve banks. And Federal Reserve banks will charge them an interest rate for this loan. And this interest rate between Federal Reserve and the banks has a special name. It's called discount rate. So the Federal Reserve go ahead and say, I'm going to lower the discount interest rate I'm charging you guys. So make them decrease the cost of their loaning. And those banks will further pass this cost saving on to final consumers and charge them a lower interest rate. Okay, so by doing so, Federal Reserve indirectly decreasing the interest rate in the public. And another thing is the Federal Reserve also acts as a fiscal agent for the federal government by collecting money owed to the government from taxes and assisting with the government spending of equally large amounts. So, how do they collect money? Instead of really collecting corresponding amount of monetary bills, they simply just change the number in the banks. It's just a number. Somebody make a payment, deduct their checking deposit amount number, and increase corresponding banks checkable deposit number. Again, I'll talk more about that in chapter 15. And it also supervises the rest of banks, make sure they're not doing crazy things just for profit, and give them guidelines, help them, and whenever it's a critical time, also as work as their last resort. And the Federal Reserve makes a periodic examination to assess a bank's profitability to ascertain that banks perform in accordance with the many regulations to which they are subject, and to uncover questions practice of fraud. And after subprime crisis, Federal Reserve imposed by bigger power of supervision. And for Federal Reserve, there are two types of federal agencies: independent agencies and executive agencies. For the executive agencies, for directly under the control of the president, so they may be prone to political pressures. But for the independent agencies, do not report direct to executive branch of government. They are independent. Fed tends to avoid political pressures from the Congress or from the president or from anybody else.